Trump's foreign tax plan explained. Is America about to lose trillions in investment? Donald Trump's new international tax strategy has shaken markets. He proposes to shift the tax burden from Americans onto foreign countries and companies. In a recent speech, he declared instead of taxing our citizens to enrich foreign nations, we should be tariffing and taxing foreign nations to enrich our citizens. This America First approach envisions abolishing the IRS, creating a new external revenue service, and forcing trading partners to pay U.S. government revenue. Trump proclaimed on social media that, for far too long, we have relied on taxing our great people using the IRS. I will create the External Revenue Service to collect our tariffs, duties, and all revenue that come from foreign sources. This chapter introduces the proposal and raises the question, what exactly is in Trump's plan, and could it really enrich Americans or backfire? Chapter 2. Corporate Tax Cuts and Domestic Production. Trump's plan would pair high tariffs with deep corporate tax cuts for U.S. companies. He has vowed to cut the federal corporate tax rate from the current 21% to 15% for companies producing in America. Retaliatory taxes on foreign levies, Section 899. Under Section 899, if Country X taxes U.S. companies more heavily than the U.S. taxes Country X companies, then the U.S. can retaliate. For instance, if the U.S. judged Country X's digital or minimum tax unfair, it could impose up to a 30% tax on Country X's corporation's U.S. profits. According to AP reporting, analysis by the Global Business Alliance, a trade group of companies like Toyota and Nestlé, finds that Section 899 could cost the U.S. about 360,000 jobs and $55 billion a year in GDP over a decade. The trade group's CEO warns that the real victims are American workers in key states, not foreign governments. Investment firms echo this. The Investment Company Institute says the tax could limit foreign investment to the U.S., a key driver of growth that benefits American families. Meanwhile, supporters, including Ways and Means Chair Jason Smith, defend it as a necessary tool against tax discrimination. Smith says it would give the president a lever to force other countries to withdraw these taxes and decide to behave. But opponents are skeptical. Experts like NYU tax law director Chi-Ching Huang call Section 899 a game of political chicken that risks harming businesses, consumers, and workers while primarily helping multinationals shift profits out of the U.S. Notably, the bill's definitions are sweeping. Any country with an OECD-style 15% global minimum tax or digital levy would be automatically labeled discriminatory. In other words, nations joining the OECD's Pillar 2 Pact could suddenly face U.S. retaliation unless they back down. Critics fear this will pit the U.S. against its trading partners on taxes, not just goods. Section 899. U.S. can raise taxes on unfair foreign taxes, up to plus 30% on foreign profits. Tariffs and the External Revenue Service. Imagine the government living off import duties instead of income taxes. Trump has floated exactly this vision, an IRS-less America funded by tariffs. But economists dismiss it. Tax experts say today, as government simply spends too much, nearly 23% of GDP, to be supported by tariffs alone. Even a 100% tariff on all imports, doubling every price, might barely match current tax revenues. In short, replacing the tax code with tariffs is seen by experts as unrealistic and inflationary. External Revenue Service. Only foreign tariffs fund U.S. government, Trump's proposal. In practice, everyone wonders who will pay. All economists agree that tariffs are paid by the importer. In reality, Americans or U.S. companies will see higher prices. Walmart's CFO already warned consumers to brace for higher costs under Trump's tariff plans. As CFR explains, a tariff is a tax on the importer. So if Walmart pays a tariff on Chinese toys, Walmart and ultimately shoppers pay. In short, higher tariffs mainly hit U.S. businesses and consumers. Tariffs, strategic taxes on U.S. importers, not on foreign exporters, economic impact on growth and investment. Raising tariffs and taxes on trade acts like a negative supply shock. It raises U.S. prices and causes factories to idle. The IMF estimates that tariffs could knock about 0.4 percentage points off U.S. GDP growth and push inflation up by about 1 point, to roughly 3%. Another consequence is on investment flows. High tariffs and retaliatory taxes create policy uncertainty, causing multinationals to hesitate. The IMF and others note that when companies fear sudden changes, they often pull back on new projects and hiring. Indeed, IMF commentary says companies may pull back on investment and expansion as they wait to see how the trade policies play out. If foreign firms foresee higher U.S. tax bills or barriers, they may delay building plants or may invest elsewhere. A report by EY for the Global Business Alliance projects that Section 899 alone could eliminate $55 billion per year of U.S. growth, cutting roughly 1/3 of the growth expected from Trump's tax cuts. In other words, this could undermine Trump's stated goal of boosting U.S. investment. Despite his claims of $14 trillion in foreign commitments to invest in the U.S., there is so far little hard evidence of new factories coming from these policies. Instead, the risks are higher prices and fewer investors. The global uncertainty is already causing markets to wobble. By April 2025, the S&P 500 had fallen into correction territory, down over 12% for the year, and the U.S. dollar hit 3-year lows as investors fret over trade wars. Global economy entering new era. Trade tensions slow growth, IMF, global reactions, and trade relationships. Even some Trump allies worry. Elon Musk, once a Trump donor, publicly called parts of the tax bill a disgusting abomination for adding massive debt. On the other hand, some Republican leaders celebrate the tariffs. But across the board, economists say these policies would drive up U.S. consumer costs. One analysis reminds us that Walmart will pay tariffs on imports and simply pass those costs on to you. Comparison to past U.S. policies. So, unlike past policies, Trump's 2025 proposals mix deep unilateral measures with little global coordination. It is a sharp departure from the multilateralism of past decades. Even some GOP fiscal hawks fear that, come 2026, we may have a tax code and tariff regime almost entirely of our own making. Trump-Xi, 2017, TCJA cuts to 21%, guilty. Biden, 2021-24, supports OECD tax deal. Trump the 2, 2025, 15% corp rate, reject OECD, reciprocal tariffs. Pros and cons, supporters versus critics pros, supporters view. Advocates of the plan believe it could yield several benefits for the U.S. economy. Leveling the playing field. By retaliating against what they call unfair foreign taxes, like digital levies on American tech companies, the U.S. could force partners to change those policies. House Ways and Means. Chairman Jason Smith says this tool protects U.S. interests and gives the president a weapon to correct imbalances. Lower corporate rates to boost growth. Lowering the corporate tax rate to 15% for domestic production and coupling it with full expensing of investments could significantly spur manufacturing and R&D in America. Economic analysis suggests that at a 15% rate, U.S. corporate tax revenue might remain near current levels while drawing in foreign investment. If successful, this could make U.S. businesses more competitive globally. Pressure to repatriate profits. Some supporters suggest that foreign countries might reduce their own taxes to avoid U.S. retaliation, or that U.S. multinationals will bring earnings home rather than pay foreign levies. In theory, this could increase U.S. tax revenue and investment. Cons, critics view. Opponents counter with multiple warnings. Higher prices and inflation. Tariffs act like taxes on imports. As the Mary Sue and other critics note, U.S. consumers pay when tariffs rise. Higher tariffs on steel, autos, or electronics would mean higher costs on virtually everything from cars to food. Economists expect this to raise inflation and squeeze household budgets. Lost investment and jobs. The Global Business Alliance analysis suggests hundreds of thousands of U.S. jobs could vanish if foreign firms pull back investment. Key swing states stand to lose tens of thousands each. The Investment Company Institute warns reduced foreign capital would hurt American savers and markets. Economic uncertainty. Critic Chai-Ching Huang of NYU calls Section 899 a game of political chicken that could paralyze planning. Companies may wait and see or avoid U.S. expansion altogether. The IMF similarly warns that uncertainty will drive investors to the sidelines. Global blowback. Many economists, journalists, and even some Republicans point out that this approach risks a full-blown trade war. Atlantic Council experts describe it as chaos that could destroy the WTO system. Retaliation from China, Europe, India, and others could target U.S. exports and jobs. WTO members also note that imposing tariffs selectively violates existing trade commitments. Unrealistic revenue targets. The plan. AS claimed that foreign countries will foot the bill is widely derided as fantasy. Tax policy experts highlight that U.S. spending demands cannot be met by trade taxes alone. A 2024 analysis noted that to replace $3 trillion in income taxes, tariffs would effectively have to double prices on all imports, an economic shock most economists say households wouldn't accept. In summary, supporters tout fairness and growth, while critics foresee slower growth, higher costs, and diplomatic conflict. It remains a stark gamble. Supporters level global playing field, attract investment, 15% corp rate. Critics higher consumer prices, fewer jobs, global trade chaos. Conclusion: a new era. For now, Congress must still approve the plan. If enacted, it could take years to see the full effects. Will these measures bring trillions of dollars of foreign investment to America, as Trump claims? Or will they backfire, costing U.S. jobs and driving allies away? Economists warn that the risks and downsides are high, while supporters hold out hope for a more America-first economy. Either way, Trump's foreign tax plan is a bold experiment with huge stakes for U.S. and global markets. Stay tuned as the debate unfolds.